we do think the euro area is sliding into recession. We expect a three-quarter recession, the fourth quarter, first quarter and second quarter. And we do think that inflation will fall as we go through 2023. So in the second half of 2023, growth is positive again. In our forecast, inflation, will be falling, we think. And so we do not look for a 1970s style stagflationary outcome here over the more medium term. And so for those reasons, near term, we think it's more likely that we see some additional weakening in the pound. Now, when you look further out, we do think ultimately the pound will recover. We also think, the euro ultimately will appreciate.
Hello everyone, welcome to SFC Markets Finance. The latest economic data showed that both the Eurozone and the UK are facing high inflation and potential recession. And the ECB predicts Eurozone economy will stagnate in 2023. While the inflation is still high, will recession take place in Eurozone and UK? When will central banks stop hiking rates? Let's welcome Jari Stehn, Chief European Economist at Goldman Sachs, to join our discussion. Hello Jari, glad to see you. Let's begin with the Eurozone economy. The recent PMI data performed not well, with business activity contracting at the fastest pace in nearly 2 years in October. Does this mean the Eurozone is heading into recession?
Yes, we think so. As you say, the data flow has weakened quite rapidly in the euro area. We saw growth through the summer that was slowing. And on our latest data points, we saw a contraction of about -1%, we think, in October. So this uses what we call the current activity indicator, which is a summary of the monthly data flow in the euro area. It includes hard data, it includes soft data, and that's running at -1% at an annualized basis in October. So a clear slowing in the data here. Now, what's interesting is that within the data, what we're seeing is that the hard data is holding up pretty well. So, retail sales, industrial production coming out of the summer has actually looked, reasonably good, has weakened, but hasn't contracted. And so we did see that just a few days ago, the third quarter GDP numbers for the euro area still showed positive growth. But I think this is really still the momentum in the economy coming out of the summer. At the same time, the forward-looking indicators are very weak. So first of all, of course, energy prices have increased hugely across Europe, and this is particularly the case for gas prices. There's recently, of course, been a little bit of a relaxation, but still at current levels, gas prices are much higher than they were just a year ago. And so we do think this big energy shocks implies a big hit to both inflation-adjusted household incomes and therefore to consumption, but also to production. And we think it's going to be an important drag on industrial activity in coming months. Now, consistent with that, the surveys have weakened very sharply. When we look at consumer confidence, when we look at business expectations, new orders, all the things that usually are a good leading indicator, those have come down very rapidly, particularly in industries that are highly exposed to gas, so in chemicals, for example, paper industry. And so we do think that signals a significant contraction in industrial activity. And consistent with that, company guidance for those firms that are exposed to the energy shock is also towards lower production later this year. And so when we put that together, we do think the euro area is sliding into recession. We expect a three-quarter recession, the fourth quarter, first quarter and second quarter. And our forecast for real GDP growth for 2023 is -0.5%. So that is below where the consensus is. Now, at the same time, we would say that's a relatively moderate recession. So it is a recession, it's a significant recession, but compared to the last couple of recessions, for sure, is more moderate. And that's because there has been some relaxation of the energy situation more recently. Gas prices have fallen quite a lot. There is quite a lot of fiscal support in the system. And then also households are sitting on quite a lot of excess savings from the pandemic, which we think will help to cushion some of this hit. But nonetheless, the energy shock in terms of size is so big that we do think it's likely to push the euro area into recession.
I think the high oil prices is caused by energy crisis. How deep could the energy crisis be for Europe, especially over the winter months?
Yes, I think that's a key focus. As I said, the baseline is for a relatively moderate recession where the rationing of gas can be avoided. So the base case is that the euro area will have enough gas to make it through the winter without needing to ration or without the need for energy outages, because the euro area has been quite successful in filling storage tanks, in buying a lot of liquid gas off the global market, and is therefore, we think, in a reasonably good position in a central scenario to avoid this very costly rationing. But the risk is still there around energy supply, and in particular, we worry about the potential implications of a cold winter. So if you got a longer and colder winter than usual, that could require more household heating, and then again push up gas prices more, which would imply more demand destruction on the industrial side and could end up implying a much bigger growth drag. And so in a downside scenario, we think 2023 growth for the euro area could be something like -2% for the year as a whole, which would be a much more significant recession than what we have in the base case. Now, one important aspect of such a downside scenario is then also the distribution across countries, because we think Germany and Italy in particular would a severe downside by such a rationing scenario. And that's really because Germany and Italy are more reliant on gas, and in particular we're more reliant on Russian gas supplies, whereas, for example, France uses more nuclear energy in its mix, and Spain has a number of alternative energy sources. And so that's why downside scenario, I think, is tightly linked to energy supply risks and would probably have quite asymmetric effects across the euro area.
Will the energy crisis cause stagflation throughout Europe?
Well, we certainly think that the energy crisis will lead to a period of high inflation and weak growth. So, we have inflation peaking at 12% in January for the euro area. And as I just discussed, we have negative growth during that period. So we certainly think that the next months will feel quite stagflationary with high inflation and very weak growth. We've also reduced our long-term forecast for the euro area economy, so for the level of real GDP, by between 3 and 4%. So that does imply significant longer-term supply damage, because we do think energy prices will remain persistently higher. Now, that said, we do eventually think that growth will come back as energy prices stabilize. And we do think that inflation will fall as we go through 2023. So in the second half of 2023, growth is positive again. In our forecast, inflation will be falling, we think. And so we do not look for a 1970s style stagflationary outcome here over the more medium term. And the key reason really is that we think a wage price spiral, which was a key aspect of the 1970s and 80s, where basically high inflation led to higher wage growth and higher wage growth led to higher inflation and so on, we think looks relatively unlikely at this point. And so, that's a key reason why we think yes, the next quarters will show high inflation and low growth, but ultimately, we do think inflation will come back down, and we do think growth will return to more normal levels once the energy crisis has been managed.
Would you like to talk a little more about why 1970s crisis will not repeat?
Yes, so as I said, the key here really is this risk of a price-wage spiral, and I think that there've been a few changes. I think since the 1970s and 80s, one is that the structure of wage setting has changed. We have a lower rate of unionization. So labor unions are less prominent in the wage setting than they were in the 1970s. We have less indexation. So in other words, high inflation now is less likely to feed into higher wages automatically via indexation. So that has changed. And then we've also seen a number of important changes on the monetary policy side. Central banks are more independent, they are more transparent, they have kind of clearer goals. The ECB, for example, has a clear inflation target now, 2%. And so all of that, we think, contributes to a more stable setup for inflation expectations and for wage setting. And so when we look at what has happened to inflation expectations and to wages, we have certainly seen some increase here in the euro area, but so far it looks fairly modest in terms of the increase in inflation expectations, for example. And so we would still say that inflation expectations are anchored. And so I think this risk of a de-anchoring of inflation expectations and a real spiral between prices, expectations, and wages still looks pretty limited for the euro area.
On the inflation front, the Eurozone CPI is still at peak. Could you let us know the reason behind?
Yes, I think it's helpful here to break inflation into the different components. So the main reason, of course, why inflation in the euro area is so high is energy prices. So we've seen a huge increase, particularly in gas prices, and that really has driven the bulk of the inflation pressure. So if you look at the headline inflation rate is running close to 11%, but when you strip out energy prices and food prices, so the most volatile components, the core inflation rate, the underlying inflation rate is only 5%. I mean, that's still high, but significantly lower than the headline. And so, on energy prices, we do think there's some more pass-through in the pipeline because wholesale prices typically take some time to feed through into retail prices. And so we think the peak here will be in January for the euro area with inflation of around 12% for the headline. And then we think that should cool. Now, core inflation, which I said, has picked up to 5%. I think it's helpful here to break that into goods and into services because the drivers are quite different, particularly for an open economy like the euro area. So, goods prices have really been driven by tradable goods, by global bottlenecks in the goods sector, particularly by durable goods prices. And of course, here we have seen a number of bottlenecks over the last months that have really implied very strong global goods price pressures. And we think there's still some more to come over the next few months in terms of these pressures as the euro area picks up and converges to the global prices here for durable goods. But then some of the forward-looking things have started to ease. So when we look, for example, at supplier delivery times, so how long it takes for goods to be delivered, which is a measure of bottlenecks, those have eased. And so we do think that on the goods price side, things should start to ease once we move into 2023. Now, the third component is services, which is more tightly linked to wage growth. And so here we've also seen a pretty substantial pickup recently. Wage growth is up, services inflation is up. And so we do think that part of inflation is probably going to remain somewhat more sticky. And so when you put that together, we think inflation still has to peak. So we look for a few more months of very acute pressures, but then we do think that as you move into 2023, the inflation pressures should start to ease.
Although the Eurozone are facing recession, the ECB still hikes rates. Is this worse for policymakers fighting inflation at the cost of growth?
Well, it's tricky. It's effectively a trade-off. It's a supply shock that we're dealing with here in the euro area, which pushes up inflation on the one hand, but pushes down growth on the other hand. So it inherently implies a very difficult trade-off for the ECB, where you want to get inflation down, but at the same time, you want to do that in a way that minimizes the cost to growth. I think for now, it's been very clear that the ECB really is focused on the inflation side of this equation, and has really emphasized our primary goal, our mandate is price stability, and we need to limit the risk that we could get a de-anchoring of inflation expectations. So these very high inflation numbers that we talked about do imply a risk that inflation expectations might drift up and that inflation might embed. And so that's why the ECB has really stepped up the hiking pace, so has now delivered 200 basis points of hikes in 3 meetings, and I think has made it very clear that they're uncomfortable with where the inflation numbers are, and that getting inflation down is the key priority. But as you look ahead, and as inflation reaches the peak, and as the economy slows, I think there are then good reasons for the ECB to start to slow down the pace of hiking. But they also said we've made substantial progress towards removing monetary accommodation. So in other words, we are getting closer to a setting where policy is more neutral from levels that were very expansionary. And so, once you get it to a more neutral level, I think there's an inbuilt incentive to take this trade-off, more seriously. And that's why, we do think it's likely that the ECB will slow down the pace of hiking from here onwards. So we think they will step down most likely to 50 basis points in December, because this trade-off between inflation and growth is evolving as you move through the cycle and as rates move higher.
How much damage to economic growth will they finally have to inflict to win this fight?
Yes, now again, we are facing a supply shock. So that does mean a substantial hit to activity and high inflation. And so I think some growth weakness really is inevitable in this environment where you face an adverse supply shock. Now, what the ECB needs to do is really to make sure that as supply contracts because energy prices are higher, that demand essentially adjusts in line with supply, such that you end up with a rebalanced economy at the end of it. So in other words, you need to avoid a situation where the potential level, the supply level of the economy contracts, but demand is held up and is held strong, because then you would end up with a situation of excess demand, which would then drive inflationary pressures over the medium term. And so, this is featured more prominently in the ECB's communication, that they do want to make sure that demand adjusts in line with supply. And so, as I said earlier, we do think this implies a recession, But of course, a lot of this recession is driven by the contraction in supply, and there isn't really anything monetary policy can do about that. But it really needs to ensure that after all of this, we end up with a situation where the economy returns to balance in terms of avoiding an excess demand or excess supply situation and having inflation converge back to 2%.
Under what condition the ECB will stop hiking rates?
Yeah, I think that's really when the outlook for inflation returns towards the target. So in other words, when the medium-term projections go back to 2%. So this is really what President Lagarde has said, what the ECB has set out as the goal. Now, currently, when you look at the projections for 2024, which is the end of the projections at the moment, they are at 2.3%. And so those inflation numbers are above the target, not hugely, not nearly as much, of course, as the current inflation rates, but still the medium-term projections are above target. And so the communication has been, as long as the medium-term inflation projections are above target, policy needs to continue to normalize and tighten to get inflation back to 2%. Now, I think, what are the conditions under which that will be fulfilled? I mean, I think there's a range of conditions that we need to consider. I think one important condition is that you get the sense that underlying inflation pressures are easing. So, as I said earlier, that we're not seeing that yet. Underlying inflation pressures are still very strong, and some measures are actually still building. And so, we don't think that we're likely to see an easing really in these underlying inflation pressures until the first quarter of next year. I think the second condition is that you need to be confident that demand is adjusting towards supply so that you can avoid an excess demand situation as supply contracts. And so, here we need to observe and monitor the incoming data very closely in coming months. But again, we think as we move into recession and into the contraction, I think it will become clear that demand is adjusting. And then thirdly, I think ECB needs to be confident that these second round effects that we discussed earlier, that those are limited. And here Governing Council members are monitoring both measures of inflation expectations, surveys, market measures, and so on, but also developments in wage growth. And so far, what we're seeing is that there's been some upward pressure on inflation expectations and on wage growth, and they're running a little bit above where the target is. But at the same time, I think the latest surveys have been reassuring in that there has been some stabilization in some of these metrics. And also the distribution of inflation expectations has started to recenter somewhat. And I think this is quite important, actually, because there's some research that shows that in the 1970s, what happened was that the distribution of inflation expectations shifted to the right and effectively kind of got skewed towards high inflation outcomes because some people expected very high inflation outcomes. And that ended up being a leading indicator for what actually happened in the end for inflation expectations and therefore for inflation. And so watching this distribution, I think, is also important. And I think we've seen some progress there that suggests that the upward pressure on long-term inflation expectations is beginning to soften. So those are the conditions that I think we need to look out for. I don't think we have met those conditions yet. And so we do think additional tightening from the ECB is likely. We look for 50 basis points in December, another 50 basis point step in February, then 25 basis points in March, and then we think we will conclude the hiking cycle at 2.75% in March. Now, of course, there's uncertainty around this. You can imagine a situation where we go a bit higher or a bit lower, but I think that's a reasonable base case for what they will do.
It seems the Fed will continue hiking rates this year. How will the Fed's decision affect the ECB? Will the ECB follow the Fed's pace completely?
And we do think that the Fed is going to slow down in December to a 50 basis point hiking pace. And we think the ECB will match that. And then we actually have a similar profile that both the ECB and the Fed will then conclude the hiking cycle in March. And one important reason here, of course, is the exchange rate, which has weakened quite substantially. The euro is down quite notably, of course, and that is an important consideration for the ECB in terms of the inflation pressures. And so I think there is some linkage between what the ECB will do and what other central banks, particularly the Fed, will do. Now, of course, the ECB will deviate from that if needed, but in our forecast, there is some synchronization here in terms of the stepping down in the hiking pace in December and then concluding at the end of Q1.
Now I want to move to the UK. What's your view on the impact of UK's political situation on its economy?
Yes, so we've seen a number of reversals of U-turns on the fiscal policy front in recent weeks. And of course, we've seen the appointment of the new Prime Minister, Rishi Sunak, and the combination of that has returned market stability to financial markets. And that, of course, is very good news. At the same time, of course, there is a cost for the economy from this. One is that we now have less fiscal support for the economy and for households. So about 2/3 of the tax cuts that were originally announced in the mini budget have now been reversed. And that does imply less fiscal support for households and therefore weaker consumption. The other effect, of course, has been that even though financial markets have calmed down, we are still looking at tighter financial conditions. We are still looking at higher mortgage rates in the UK. And we think both of these things, less fiscal support, tighter financial conditions, do imply a bigger growth drag in coming months. And of course, the incoming data in the UK has been pretty weak. When we look at our current activity indicator, so this growth summary measure I mentioned earlier, that is running at about -4% in the UK on an annualized basis. So quite a bit weaker, both in the US or the UK. And so as a result of this, we have cut our growth forecast more for the UK. We now look for growth of -1.4% in 2023, which is quite significantly below consensus. So we have a 4-quarter recession, in the UK with a below consensus, growth forecast.
Some economists view the UK economy as Italy. Are they comparable?
Well, I wouldn't overemphasize the UK's debt sustainability concerns. Now, of course, debt is higher and deficits are higher than we thought a few months ago. But it's important to keep in mind that debt is still lower than in many other G7 economies, so including Italy. So the UK's debt, we think, will be somewhere around 100%, whereas Italian debt is around 150%. And of course, some other countries like Japan have even higher public debt ratios. Also, the average maturity of the UK's debt stock is quite a bit longer. So it's about 14 years which is about twice as long as, for example, in Italy. And so I think that is also something that helps to shield the UK debt outlook. And then lastly, and I think this is the most important point, is that the UK, of course, has its own monetary policy and has its own exchange rate. And, historically, what we see is that the hurdle for countries with their own monetary policy and their own exchange rate to get into sovereign trouble is pretty high. And it really limits the fiscal risk, because the exchange rate, of course, can adjust when there are shocks and unforeseen circumstances, of course, as we saw over the last few weeks. And I think that's really the key difference between the UK and countries that have a fixed exchange rate like Italy. And so, we are, less concerned around the UK's fiscal sustainability outlook for those reasons.
Do you think when British pounds will begin to appreciate?
Well, near term, we don't think so. We think that the pound will weaken somewhat again. And, there's both a broader dollar effect here. We think the dollar, generally will strengthen a bit more in the near term, including against the euro, because ultimately the US has a very tight labor market, still has decent growth. Growth has slowed in the US, but we don't expect a recession in the US, and the Fed is still hiking, and we now think will hike to a level close to 5%. And so, we think that will lead to some more dollar strength. And then on the UK side, we think that the outlook for growth, as I said, is pretty weak. And we also think that the Bank of England will under-deliver on the number of rate hikes. So our terminal rate for the Bank of England is 4.5%, which is somewhat below market pricing, which is closer to 5%. And so for those reasons, near term, we think it's more likely that we see some additional weakening in the pound. Now, when you look further out, we do think ultimately the pound will recover. We also think, the euro ultimately will appreciate again towards more normal levels, but that's not in the near term, we think.
Mm-hmm. Besides political issues, what's the biggest problem for UK economy now?
Yeah, I think that's inflation. That's the problem of high inflation that the UK has. So we see a very tight labor market in the UK. The unemployment rate has fallen to the lowest level since 1974 at 3.5%. Wage growth is running at strong levels. In the latest data, wage growth picked up to 6%. And measures of core inflation have been very firm. When you look at core CPI inflation, for example, that picked up to 6.5%. And when you look at the run rate over the last 3 months, UK core inflation has been stronger than either in the US or the euro area. And so we think the big challenge in the UK is to reduce inflation. And of course, the UK, in many ways faces both the challenge that the US has, which is excess demand and a very tight labor market, but also the challenge that the euro area faces, which is the big energy shock. So it's really the combination of those two influences that implies a big challenge to get inflation down. Now, this is the reason why we think the Bank of England will hike quite decisively, and then we think they will take the policy rate to 4.5%, which is a clearly contractionary level. Now, it's not quite as high as where the Fed is. It's not quite as high as market pricing is for the Bank of England at the moment, but still 4.5%, we would say, is contractionary and will then help to cool these inflation pressures.
Mm-hmm. Do you think the political and the economic issues are Brexit secular?
Well, so there are, of course, lots of estimates that suggest that Brexit is bringing significant longer-run costs. These estimates center around 4%, but these studies also show that we've probably already seen most of that cost in the data, even ahead of COVID. So the UK economy underperformed between the referendum in 2016 and the onset of COVID. So when you compare growth in the UK, or when you compare investment in the UK with similar countries, with neighboring countries, you clearly see an underperformance. So I think it suggests that the economy has already paid a significant portion of that longer run cost of Brexit, because the trading arrangements are less favorable than they used to be. But I think there's also a more subtle implication of Brexit that is at play, and that really is that Brexit has made the labour supply for the UK more inelastic. So what I mean by that is that historically, and so during the 2000s, for example, that whenever the UK labour market got strong and heated up, you had a lot of workers flow into the UK labour market from the rest of the EU, particularly from the east of the EU, and that avoided an overheating of the labour market. So you could see strong growth and a tight labour market, but without strong inflationary pressures during that time. Now, of course, this flow of workers has been curtailed, has been reduced, and the supply of workers has become more inelastic. And I think that likely contributed to the overheating of the labour market that we have seen, because the labour market is finding it hard to find workers to fill vacancies, and that has contributed to a pickup in wage growth and therefore to inflation. And so I think this is one of the more subtle implications of Brexit, probably, that we are currently seeing at play.
Mm-hmm. Finally, what's your outlook on the UK economy in the short term?
Yeah, we also think that the UK economy is headed for recession. We have 4 quarters of negative growth in our forecast. The reason is pretty similar to the reasons for the euro area. It's really the size of the energy shock, and also that the UK is quite reliant on gas in its energy mix. So the UK was less reliant directly on Russian gas supply because it gets more of its gas from Norway. But of course, the prices of gas across Europe are highly correlated. And so gas prices, of course, have also gone up a lot in the UK. And the UK uses a lot of gas in its energy mix. And so, we think the hit to growth is going to be quite sizable. And we have a growth forecast of minus 1.4% for 2023, which is below consensus and also below what we expect for the euro area. And so we do think there's a significant recession in train. Now, that said, I would say, it's still a moderate recession, minus 1.4%. It's not nearly as severe, of course, as the financial crisis or COVID. And the reasons are that, there is some fiscal support that is helping. So, the energy price cap that has been announced, at least for 6 months, will help households cope with the energy crisis. And households are sitting on a significant amount of excess savings that they accumulated during the pandemic. And so baseline for us is a significant recession, but one that's ultimately a moderate recession.
All right, thanks again, Jari. See you. The UK and the Eurozone are very likely to face a downturn in the coming months as high inflation takes a toll on activity. We will continue to track the trends of Europe's economy. That's all for today's show. See you.